Most beginner investing guides out there start by telling you which hot tech stock to buy or which crypto is supposedly about to go to the moon. But honestly, that is the absolute worst way to start. Because if you try to build a portfolio by chasing the latest trends, you're not investing, you're gambling. There is this completely toxic culture of stock picking right now that makes everything feel like a high-stakes casino, just full of confusing jargon, complex spreadsheets, and frankly, a lot of day trading stress. But the source material we're looking at today shows us that true wealth building is actually incredibly boring, incredibly simple, and it's something you can literally start doing today with just $50 or 50 pounds.
Welcome to today's Explainer. Today, we are entirely stripping away the intimidation factor. We're going to look at an incredibly straightforward, step-by-step system from our source guide to build a bulletproof, set-and-forget investment portfolio from absolute scratch. No stress, no waking up and obsessively checking red and green arrows, just a rock-solid strategy designed to put your money to work in the background of your life. Okay, let's dive into this. Here's our 6-step roadmap for today. 1. Pre-investing prep. 2. Goals and time horizon. 3. Strategy and platforms. 4. Mastering asset allocation. 5. The 3-fund portfolio. And 6. Consistency and mistakes.
All right, kicking things off with Section 1. Pre-investing prep.
So, let's start right at the foundation. Because, as our guide points out, the most crucial moves you'll ever make for your portfolio actually happen before you even buy a single stock. The text outlines 2 absolutely vital steps to take before investing. Step 1, pay off any high-interest debt. And Step 2, build a starter emergency fund. You want to aim for 3 to 6 months of basic living expenses safely tucked away in a high-yield savings account. The reasoning here is that you need a financial fortress. I mean, the absolute worst thing you can do is put your rent money into the stock market, watch the market take a temporary dip, and then be forced to sell your investments at a loss just to pay your bills, or, fix a flat tire. Your emergency fund acts as this huge protective wall around your investments.
And regarding that debt, 20%. That is the number to remember. If you have credit card debt charging you 20% interest, paying that off is a guaranteed 20% return on your money. Literally, even the greatest investors in the world, in the greatest stock markets in history, cannot consistently beat a 20% return year over year. So, for sure, clear that debt first. It is the smartest investment you can make.
Moving right along to Section 2, Goals and Time Horizon.
Before you put a single dollar or pound into the market, you really have to figure out exactly what you're investing for. Are you trying to buy a house, saving for your kids' education, or maybe building a retirement nest egg? Your goal entirely dictates your timeline and your risk level. This comparison here is basically a golden rule to live by. If you need your money in under 3 years, say for a house deposit, do not put it in the stock market. Keep it in a savings account or a money market fund. It is just way safer there. But if your goal is over 5 years away, like retirement or general long-term wealth, then the stock market makes total sense. While the stock market offers much better historical growth for the long term, investments can and definitely will go down as well as up. You just need enough time to ride out those waves.
Okay, Section 3, Strategy and Platforms.
Now that we know our timeline, the source material introduces the actual mechanics of setting up your investments and choosing the right vehicle for your money. You really have 2 main choices here, the automated approach or the DIY approach. If you want absolute simplicity and low effort, a robo-advisor is fantastic. You basically just answer a few questions on an app, and it automatically builds and manages a diversified portfolio for you for a tiny fee. On the other hand, if you want full control and the absolute lowest costs, you can open a DIY brokerage account. Whichever route you choose, the key is to pick regulated platforms with low fees. Look for FCA regulation or FSCS protection if you're in the UK, and ideally, a really easy-to-use app.
And speaking of the UK, the guide highlights these specific account types as the absolute best starting points for listeners based there to really maximize tax efficiency. First up, the Stocks and Shares ISA. This allows you to invest up to £20,000 a year, completely tax-free. No tax on the growth, no tax on the dividends. Amazing. Then you have the SIP, which is a personal pension that actually gives you government tax relief. And finally, the General Investment Account, which honestly, you should really only use after you've totally maxed out the other tax-advantaged accounts. Always protect your money from unnecessary taxes first.
Which brings us to Section 4, Mastering Asset Allocation.
Now, what's really interesting about this concept is that it drives around 90% of your long-term portfolio returns. It's not about picking the winning stock. It's about mastering asset allocation. Think of it exactly like baking a cake. You need the right mix of ingredients in the right amounts. The two main ingredients in our investing kitchen: stocks and bonds. Equities, or stocks, are your high-growth, high-volatility ingredient. They make your wealth rise over time. Bonds, on the other hand, are your stability ingredient. They offer lower growth, sure, but they act as a crucial cushion when the stock market gets bumpy.
So how much of each ingredient do you actually use? Well, the Bride offers a really actionable formula called the Rule of 110. It is brilliantly simple. You just subtract your age from 110, and that number becomes the percentage of your portfolio that goes into stocks. The rest goes into bonds. So for example, a 30-year-old would subtract 30 from 110, leaving 80. That means 80% of their portfolio goes into high-growth stocks, and the remaining 20% goes into safe, stable bonds. Boom! It instantly calculates a risk-balanced pie chart customized exactly to your age.
Let's look at Section 5, the three-fund portfolio.
All right, let's transition from the theory of asset allocation to the actual ingredients you need to build the simplest portfolio in the world. First, the text clarifies one critical piece of jargon, the ETF, or index fund. Instead of buying a single share of one company, think of an ETF like a giant shopping basket. When you buy an ETF, you are buying a basket filled with small pieces of hundreds or even thousands of different companies all at once. It gives you instant diversification for a tiny, tiny fee, usually between 0.05 and 0.20% a year. So you're no longer putting all your eggs in one basket, you literally own the whole supermarket.
And this all comes together to form the legendary three-fund portfolio highlighted in the text. Instead of tracking hundreds of different investments, you just buy 3 ETFs. First, a total U.S. stock market ETF. This gives you a slice of over 3,000 major companies like Apple, Microsoft, and Amazon. Second, a total international ETF. This spreads your risk globally across Europe, Asia, and emerging markets. And third, a total bond market ETF, for that steady cushion we just talked about. By holding just these 3 funds, you own a piece of the entire global economy. If one company goes bankrupt, it doesn't even matter because you have thousands of others holding you up.
Finally, Section 6, Consistency and Mistakes.
So we've built a portfolio. But the guide strongly emphasizes that once the portfolio is built, the true secret to long-term wealth is behavioral consistency. It's all about how you feed this portfolio. Enter dollar cost averaging or pound cost averaging. This simply means you invest the exact same amount regularly, maybe $50 or 50 pounds every single month, regardless of what the news is saying or whether the market is up or down. By automating this monthly transfer, you completely remove the psychological pressure of trying to time the market. When prices are low, your $50 buys more shares. When prices are high, it buys fewer. Over time, it perfectly smooths out your costs. Because remember, time in the market always beats trying to time the market.
Now, the source material does warn against a few classic pitfalls to avoid. First, do not try to get rich quickly. Good investing takes years, not weeks. Second, do not put all your money in one hot stock. And please, never sell in a panic when the market drops. Market volatility is completely normal. Actually, a great rule of thumb from the guide is the sleep test. If your investments are keeping you up at night with worry, your portfolio is simply too risky for you, and you probably need to add more of that bond ingredient.
And that brings us to the ultimate realization for this educational portion. Once you've paid off your debt and you've automated your monthly investments into your diversified 3-fund ETF portfolio, the absolute best thing you can do for your money is absolutely nothing. Let it sit. Let it grow. Investing should be a boring yet highly effective background habit. Patience is quite literally your biggest asset here.
You have the roadmap now to bypass the jargon and build a portfolio that stands the test of time. So I want to wrap up this explainer by leaving you with one final thought. What is holding you back from buying your first ETF? The tools have literally never been cheaper, and the process has never been easier. It's time to take that first confident step into the market. Thanks so much for learning with me today, and I'll catch you on the next explainer.